Well, markets are at all-time high and union budget is going to get announced tomorrow. Let's understand how much money banks has into their bank account. Okay? So there is a term called loan deposit ratio, LDR. So loan deposit ratio is what? Like how much deposit has grown in the bank versus how much money they have given away to the people. So advance or loan they have made versus the deposit has been made in the bank. So one of the largest private sector bank has announced yesterday that their deposit has grown by 24-25%, but the advances has grown by almost around 53-54%. So it's more than double. Advance is growing or loan is growing at a much more rate than what they get the deposit. So let's understand this, that when the deposit is growing but growing at a less rate, and banks are making more advance at almost double the rate. So in that case, sometime RBI also intervenes when they see that, oh, the balance is not correct. Then they say that, hey, you maintain this healthy balance. But here is the dilemma I want to talk about. The dilemma is when a bank gets the deposit and makes the advances. So when they are making the advances on giving away the loans, that's when they make the money. Okay, because when they get the deposit, they pay certain interest on that account. The money gets deposited, and when they give the advance, then they make the money in the form of interest they charge to the customers or institutions or anything. So in this case, we have to understand that any bank which is very, very ambitious, they want to grow more, they want to grow at a very, very rapid rate, then in those cases, they want to give more advance. But giving more advance also comes with higher risk. If you are giving more advance and if the money is not coming back and if it is getting translated into NPA, then you have a big problem. So you have to maintain this ratio, manage this ratio, and that's where the experience, expertise of all these large CEOs or type of funds you want to give, whether you want to advance very, very small ticket loans or you want to give the large ticket sort of loans. If you give the large, then maybe it is very quick for you. But in that case, you are also encountering larger risk. If that one corporate will default taking your advance, then you are in a deep trouble. So always they just see this loan deposit ratio. This is a very, very important matrix. One of the possible reason could be a lot of cash outflow is happening into the capital markets as well, but it has nothing to do with this specific concept. The liquidity is high. People are taking advances. They are deploying money into different sort of things. But this is a very, very unique and important matrix I wanted to discuss before the budget, because in budget also government also has some liquidity. Some liquidity they create by external borrowing, some liquidity they get by collection of the GST, and then they deploy that liquidity on different projects like infrastructure projects or whatever. So the banks also operate in a same way. There is no formal term, but in a way, government also operates in a similar way. So understanding liquidity, how much banks are receiving versus how much they are giving away, and how much risk they are taking to grow at what rate is very, very important. And one of the key success factor or one of the key success in a banking industry or any large bank looks after is striking a right balance between this ratio, not only this ratio, but also what kind of loans, what kind of advances they want to give it away to the people or corporates. Thank you so much.